Good morning, everybody. It's Thursday, June 20th, 5:25 a.m. Central Time. Grain market's a little bit lower this morning. December corn futures down 1.5 at 466 and a quarter. November soybeans down 1.5 at 1130 and a half. December Chicago wheat down 5 at 618 and a quarter. December Kansas City wheat down 5 3/4 at 622. December spring wheat down 4.5 at 655. Let's start off the weather.
Overnight rains pushed across portions of South Dakota, Minnesota, Iowa, northern Illinois, and Wisconsin. Rainfall over the last 72 hours was confined to many of these same locations. The forecast calls for above normal temperatures across the Corn Belt for the next 5 days. The western Corn Belt is likely to see additional rain during this time frame, while the east will remain mostly dry. There is some model conflict between the Euro and GFS during the 5 to 10 day period. The Euro is dry for the eastern Corn Belt, while the GFS is slightly wetter. The extended GFS introduces widespread eastern Corn Belt rainfall during the first week of July.
If this extended GFS is correct and these rains do fall as advertised during the first week of July, you can probably kiss any sort of summer weather event or weather rally goodbye. It's probably not happening in your normal like 4th of July timeframe. That being said, these forecasts that are 10 to 15 days out or whatever, they can change drastically. So we're looking at, a week at least of hot and dry for half the Corn Belt. And if this forecast is inaccurate, if this GFS is not correct and the east stays dry, I think you've got yourself a weather story. But for right now, the trade must be working with the idea that these rains are coming back in. Weather is bar none the biggest driver of prices this time of year. And that's why you need to sign up for our premium stuff and see Pete's pre-open weather updates on Sunday nights. This is going to be super, super important stuff here the next 3 or 4 weeks.
Wheat futures have collapsed. All three classes of exchange-traded U.S. wheat futures posted fresh multi-week lows again overnight. On a continuation basis, spring wheat futures are within a few ticks of their lowest trade since April 2021. The market rallied sharply in April and May on concern regarding the Russian wheat crop. The trade is now downplaying Russian crop losses following additional scouting and improved weather. U.S. wheat never really saw an uptick in export demand.
This is a monumental collapse in prices. Spring wheat futures in particular acting incredibly poorly. So you had your Russian crop scare event. We've seen similar overseas crop scare events. We had a Brazil crop scare event as it relates to soybeans back in October, November. We had a similar one with Russia here in April and through most of May. And it's totally fallen apart. I've heard rumblings that maybe the frost damage and the drought damage in Russia was not as bad as advertised. And some of these private groups that were, talking Russian wheat crop 80 or sub 80, maybe they're too low. Maybe even USDA went too low with an 83, or maybe it's simply that there's enough wheat in the world and we never saw an uptick in U.S. export demand. But in any case, it's a terrible, terrible action, and it doesn't bode well. I'm not going to say this is the reason corn can't rally, but it doesn't help.
So if you guys have not checked out our premium content, you need to do so. Joe, can you tell me about Tuesday's video?
China has not purchased one single cargo or one single bushel of U.S. soybeans for new crop delivery. And the question that we sought to answer on Tuesday was, can China really avoid U.S. soybeans? This was a question, a series of questions that came in from a subscriber. And I had, 10 or 12 supply and demand charts trying to explain this situation. It's kind of a rhetorical question because I don't think China will actually avoid U.S. soybeans. But some interesting kind of thought exercise type stuff here. If you guys want to see the premium stuff, go to standardgrain.com. You can sign up this morning. This is a $50 per month subscription. You can cancel at any time. There's no other fee, no other obligation. Nobody will try to sell you anything else. You'll get our email every single business day at 5 a.m. Central Time. That email includes tons of charts, graphics, overnight headlines. All of my cash grain marketing recommendations are included every single business day. You can jump on the text list. That's part of the deal here. Check that deal out, guys. It's the best way to support the channel and the podcast and YouTube. That stuff doesn't pay us anything. We are able to exist here on the internet because of the premium subs. So give that deal a shot.
U.S. corn and oil industry groups are suing the Biden administration. On Tuesday, the groups filed a lawsuit arguing the administration's plan to reduce car emissions will negatively impact the economy. Earlier this year, the EPA established new rules for heavy-duty vehicles released from 2027 through 2032 that will reduce greenhouse gas emissions by 1 billion pounds through 2055. Another set of regulations will require 56% of all car sales to be electric between 2030 and 2032. The groups involved in the lawsuit believe the EPA has prioritized EVs over other climate solutions, such as ethanol.
So basically, they want you to drive electric semis. Is that?
Yep, that's
Is
the
that
plan.
That's the plan. Okay, this is what somebody from API said about this. And again, this is big oil and big corn, if you want to call it that, joining forces. Somebody from API said this: the EPA is forcing a switch to technology that simply does not presently exist for these kinds of vehicles. And even if it were someday possible, it will almost certainly have consequences for your average American. There was a joint statement from National Corn Growers, American Farm Bureau, and Owner Operator Independent Drivers Association, which I think is truckers. They said this: EPA has tried to impose a one-size-fits-all approach to addressing climate change by prioritizing electric vehicles or over other climate remedies like corn ethanol. So I don't know. I think they're going to have to backpedal on some of these EV regulations because I don't feel like we're moving fast enough.
The estimate for the 2024 federal budget deficit has increased by $400 billion. The Congressional Budget Office is projecting the deficit will reach $1.9 trillion, the third largest annual deficit in American history. Some key contributors to the increased spending include military aid to Ukraine and Israel, paying off student loan debt, and increased Medicaid spending. The nation's publicly held debt is expected to rise to 122% of the GDP by the end of 2034, the highest level on record. The cost of President Joe Biden's open southern border policy, which has increased state and local spending, is not included in the CBO report.
If you pay taxes in this country, I would highly recommend that you go read this report. It's absolutely terrifying, first off. And secondly, this is stuff that you're never going to see in the news. You're never going to see politicians talk about it because it's so damn terrible. The situation is incredibly awful. It's not politically popular to talk about this because it's an impossible situation. The only way out of this would be to cut spending or become involved in some sort of austerity measures, and none of that's going to happen. The debt to GDP thing is interesting. I had a couple different graphics here. Okay, so here's our budget projection for this year. Your outlays, $6.8 trillion. Revenues, only $4.9 trillion. Okay, there's two different debt to GDP ratio statistics. This one says that we're at 99 currently and that we're going to 122, 122% debt to GDP. But then the Fred number, which I think is the more recognized number, is that we're at 122% debt to GDP. The stat that Jim always likes to throw around is this one. Since the year 1800, 51 of 52 countries who have reached 130% debt to GDP have defaulted. I would make the argument personally, and some of you may disagree, we actually defaulted in 2008 when we bailed out the banks. It was a soft default because without bailing out the banks and the money printing that was involved in that, the economy would have collapsed. The banking system would have failed, all of that stuff. And then it accelerated and got even worse with COVID. All of our financial problems can be tied to money printing and easy money policies. That's it. And those policies, your money printing and your easy money policies, they have benefited the top, say, 20% of those in the country, and more so the top like 1%. A lot of this money that was printed goes back to the top 1%, your politicians, your billionaires, that sort of thing. And if you're on the bottom rung of the ladder in the economy in this country, you have been very hurt by inflation and these easy money policies and that sort of stuff. So it's an absolute disaster. It's an absolute disaster. And, you know, when Biden and Trump debate here in a couple weeks, they're not going to talk about this because it's too incredibly terrifying. Okay. Is there anything fun next?
Sort of. The S&P 500 climbed to a new record high on Tuesday. NVIDIA fueled the index by surpassing Microsoft to become the world's most valuable public company. The chipmaker overtook Apple earlier this month for the first time since 2002. NVIDIA shares gained 3.5% to close at 135.58 on Tuesday. With its shares up more than 170% since the start of the year, the company is now valued at about $3.3 trillion. The NASDAQ also reached a new record high on Tuesday as a result of the surge in tech stocks.
You see the world's largest company flip-flop all the time. NVIDIA became the 12th company to be the largest in the S&P since 1926. Prior companies that had been the largest include AT&T, Apple, Cisco, DuPont, Exxon, General Electric, General Motors, IBM, Microsoft, Philip Morris, and Walmart. Can you believe Philip Morris was once the largest company in the S&P? Nice. Anyways, that's why personally I prefer to invest in the index and not in individual stocks. That's not a recommendation, but it's just too hard to pick which one's going to be great. When you buy the index, you get to own NVIDIA and whatever else is going to be the largest company. A lot of the rally, I think, my personal thought is that, yeah, there's some good stuff going on in the economy, but also the S&P is priced in dollars and it's a currency debasement play to a significant extent. What did cattle do on Tuesday?
Yep. So they softened. Feeders were an average of $1.52 lower. Live cattle were an average of 49 cents lower. Boxed beef was mostly unchanged on Wednesday. Choice ended the day at $320.70. That was up 18 cents. Select ended the day at $303.26. That was down 95 cents.
Outside markets, U.S. dollars up a little bit. Stocks are up again. The S&P is up 24. The Dow's up 40. I believe that should be new all-time highs again in the S&P. Bonds are down a little bit. Precious metals up, and crude oil is up 6 cents in August WTI at 80.77. Hey guys, July grain options expire tomorrow. Make sure you take a look if you have remaining open positions. Have a great day today. We'll talk to you Friday.